Good evening, everyone. I'm Tracy Allison. I represent the Champaign Public Library. Tonight's webinar is on retirement income. It's part of our Money Matters series, which is held every third Thursday of the month at the Champaign Public Library. It is in library news. Today we announced that we are actually reopening to the public on February 1st. It's going to be kind of like a grab and go model. You know, you can't hang out too long in here. Although we're still currently closed to the public until that date. We're still operating our phone, chat, and email reference services, as well as curbside pickup for any items that you place on hold. For more details on this and all of our updates, you can go to champaign.org. So I'd like to introduce our presenters for the evening, Jennifer White and Scott Olthoff. They're financial representatives at Chesser Financial here in Champaign. We're so grateful that they've come tonight to share their expertise, and I will leave you guys both to it.
Well, welcome. As our host said, and thank you to the Champaign Public Library. We really appreciate the opportunity to join you all tonight. My name is Jennifer White. The other individual you see on your screen that you may not recognize is Scott Olthoff. We're with Chesser Financial. Chesser Financial is located on Devonshire Drive here in Champaign. Both Scott and I have worked at Chesser for a number of years. Scott's been here for 10 plus years. I've been here for 4. And we just really enjoy doing these workshops, working with our clients and doing educational things like this. So we're glad you're here tonight. So our subject matter tonight, which is really important, we've all had a rocky, for sure, last year with markets and volatility, but we want to talk about retirement income and charting a course so that your money will last. So our commitment to you this evening is really 3 things. Number 1, we will provide sound financial information. Number 2 is we want to help you identify your goals. And number 3, we will offer as part of this presentation just a complimentary consultation, 1.5 hours. If you want to bring anything in and show us and ask more specific questions, we are happy to do that, no obligation. We will make appointments for that. Our contact info at the bottom is at the bottom right, in the bottom right hand corner, and you can email us. You can email us questions tonight. You can also put them in the chat, and the library's been kind enough to host that. And so multiple ways to contact us. Also, if you would like, we have this, you can see it on your screen. I have one right here as well, Retirement Income Workbook. We've had great feedback from our clients on this. It's a very helpful tool to kind of identify your goals and to kind of think through your assets. And we are happy to send you one if you just shoot us an email below. So I am going to go ahead and turn it over to my colleague, Scott.
Thank you, Jennifer. So we're going to talk about what happens when you retire. What will change in retirement? Financial focus shifts. We change from accumulation to withdrawing assets and generate income stream that will last a lifetime. There's like 4 things we're going to cover tonight. The first thing we're going to talk about, prepare for the unexpected, some things you need to watch out for as we head towards retirement. Second, we'll talk about envisioning retirement, refining your investment mix, and then choosing a distribution method for tapping those assets. Now, one of the things we have to watch out for is longevity risk, so which is a great thing. So in the United States, if you are married and you and your spouse reach 65 years old, you have an 83% chance of one of you living to age 85 and a 34% chance of living to age 95. So we have to, so if you're planning for retirement, you have to make sure you mitigate that longevity risk. We want to plan through life expectancy to 95 or 100 years old, just to make sure money doesn't run out. Another thing we got to watch out for, inflation risk. We've all experienced this, a loss of purchasing power over time. You know, we all know we go to the grocery store every year. You know, I'll give a good example. Consumer goods have really skyrocketed. I've been shopping for toilet paper and paper towels. They're a lot more expensive this year than they were last year at this time. $1 million sitting in a bank account today with a 3% inflation 30 years, that's going to spend like $411,000. So inflation's a big risk as we head towards into retirement as well. Another thing, rising cost of healthcare. It says a 65-year-old couple who retired in 2019 may need about $300,000 to cover their healthcare expenses in retirement, and that's with Medicare. So healthcare is very, very expensive. We all know that. We've all experienced that. Just make sure you have working with someone to develop a plan to cover those things. Personal health risks. So not only in my family have I seen this, but many of you have seen this in your personal families. Example, this is the Wilsons. They had $750,000 in their portfolio, and they expected their assets to last to age 86. But what happened is Mr. Wilson had a crisis. It took out $278,000 to cover that long-term care crisis, and now the money's only going to last to 77. So long-term care costs in the state of Illinois is between $90,000 and $100,000 a year. Make sure you have a plan or a way to tackle that, and not just use cash, because that can be very, very costly. Unpredictability of financial markets. We sure saw this in 2020. At the beginning of the year, markets were rolling through early January into early February. They took a nosedive. We lost 30% in the S&P for a while, and then it comes roaring back through the end of the year. And here's just three examples from past history, 6-year history, from 95 to 99, 2005 to 2009, and 2015 to 2019. You can see how the volatility of the markets. So we're going to have a plan to offset some of that risk in the financial markets. So Jennifer, you want to take over from here?
Yeah, so I'm going to talk about envisioning your retirement. So how do you envision retirement? What are your goals? Where do you want to live? What kind of income do you want to have? So how are you we talked about what kind of income do you want to have? How do you plan to support your desired lifestyle? What to do if you haven't accumulated enough? You may need 70 to 80% of pre-retirement income to maintain your lifestyle to live comfortably in retirement. Scott just went over some of the risks: longevity, healthcare, inflation. And so, accounting for those risks when we're thinking through those questions. So I want to jump to sources of retirement income. So I'm going to walk through personal savings and investments first. Then we're going to talk through the big one, which is Social Security, and then continued employment earnings in retirement. So personal savings and investments, let's talk about some of those sources. So there are tax advantage vehicles. The tax advantage vehicles allow you to save and defer taxes. So since you're not paying taxes, the money you would have paid in taxes is allowed to earn money. And so that's why those are called tax deferred or tax advantage vehicles. So employer-sponsored retirement plans, as many of you I'm sure are very familiar with, those are tax-deferred vehicles. So you get to put a deposit into your employer-sponsored retirement account. Sometimes there's a match to it, and it's pre-tax. So it's before the government takes taxes out of your paycheck. IRAs as well, and annuities are also tax advantage vehicles. Taxable vehicles would be brokerage accounts. These are where you get paid, the government's taking their taxes out, but you want to go and invest. You're going to, in a brokerage type account, pay taxes, what we call capital gains taxes, on the growth of that money. So a different tax structure. CDs and bank savings accounts, other non-tax advantage investments. So let's talk a little bit about Social Security benefits. So if you were born 1960 or later, Social Security considers your full retirement age there in that second column all the way at the bottom as 67. If you were born prior to 1954, your full retirement age is 66. So between 1955 and 1959, it's broken down by months. That's why sometimes on your Social Security statement, you might see 66 and 8 months is your full retirement age. If you choose to turn on your Social Security benefit at the earliest possible age, that would be age 62. And so if you did that and you were born 1960 or after, you'd only be eligible for 70% of your full retirement benefit. And that would stay like that for the rest of your life. Other than Social Security does give cost of living increases, not every year, but often. That's not including those cost of living increases. If you decide, let's say you were born in 1961 and your full retirement age is 67, and you decided, hey, I want to wait to take my benefit, you can wait at the latest to age 70 to turn on your Social Security benefit. And the neat thing about that is Social Security will roll up your full retirement age benefit 8% each year up to age 70. So you'd actually be able to have 124% of your full retirement age benefit. So let's look at the numbers on the next slide, and it'll kind of help us get a visual. So if at age 67, we go into Social Security, we turn in our application, they say, hey, we're ready to turn this on. $2,000 a month is going to be your Social Security benefit. Now, that doesn't include taxes or Medicare premium deduction, but it's $2,000 a month. If we came in early at 62, that benefit would be $1,400 for the rest of our lives. If we decided to wait till age 70 to turn that on, it would be $2,480. So then a good question would be, you're thinking about longevity, right? So when you're thinking about, do I turn it on at 67, or do I turn it on at 70, or do I turn it on at 62? And so that can be a little bit hard to predict, but that's something that we can kind of walk through and do different simulations with our clients. It's also important to know that when you have a spouse, taking into consideration your spouse's spousal benefit, there's different strategies with that as well. So those are just different things that we could dig into the weeds a little more if you guys have specific questions, or just if you wanted to talk to us directly. So continued employment earnings. So this is a really interesting statistic. I'm probably one of these people. I think I would be very bored if I wasn't working in retirement, but although 8 in 10 workers think they will work for pay in retirement, the stats show that only 28% of us actually do work. So that's not necessarily something that we can, count on as an income source in retirement. So Scott?
Yeah, so great. I learned this today, Jennifer, that the raise people will see is 1.3% in 2021. I saw that somewhere today, and interesting. And I've had personal experience with that. I was, my dad, when he was 62, that's when the financial crisis happened in 2008, and he was forced to turn on the Social Security early so they wouldn't lose their home. And my mom's a few years younger, and now she retired a year ago, and now she turned her Social Security on when she hit her full retirement age. So there's strategy involved. There's so many ways you can turn Social Security on, and when to do it so it's to your benefit. Make sure you're working with someone to figure that out, because it's very, very complicated, and you can miss out some very important benefits. And then if you have questions, just send us an email at the bottom there. We'd be glad to help you with that. So now we're going to talk about refining your investment mix. So we want to develop a sound investment strategy. We're talking about investment objectives, time frame, and also risk tolerance. And asset allocation is kind of a fancy word that gets thrown out there. It really just means a systematic approach to diversification that determines an efficient mix of assets for an investor. So let's take a look what that means. Here's a sample asset allocation model. First one on the left is a conservative portfolio. If we look at the breakup, 50% bonds, 20% cash alternatives, which could be like CDs or money markets, 30% stocks. And if we look at the performance from 2000 to 2019, the best year was 18%, the worst year was -11 or so, and the average is 5.49 over that 20-year period. Now look at the aggressive portfolio. We have 75% stocks, 20% bonds, and 5% cash alternatives. The best year was almost 27%, worst was -26, and the average is 5.93. I don't know about you, but I'd probably sleep a lot better at night if my portfolio wasn't going down 25%. Yeah. The person on the right lost a lot of sleep for not a lot of gain over that 20-year period. So you just got to make sure you understand what those portfolios mean, how risky you are, and how risky you want to be in retirement, and work with someone to help you through that process. We want to choose a well-diversified investment mix. Cash alternatives for preservation of portfolio, bonds for stability and income, stocks for growth potential, and then mutual funds and ETFs for a variety of different goals. Managing your tax liability in retirement is so key. So one of our main values here at Chester Financial is come along and stop financial losses in people's lives. We believe it's more important to stop a financial loss than to pick winners. We can't pick, we have no idea when the stock market's going to bust or boom, but we can come along and stop financial losses. One of the biggest ones is taxes. So ordinary income rates today, taxes are on sale. So the ordinary income tax rates, 10, 12, 22, 24, 32, and 35, and 37%. Now those, if Congress does nothing, will automatically step up 2 or 3% or even more on January 1st, 2026. So there are some strategies you can take this year and in the next couple of years to kind of manage your tax liability for future years. And so you need to work with your CPA, work with someone like Jennifer and I to do that. You want to make sure when you're talking about Social Security too. So it's very strategic of putting income, and then also when Social Security becomes taxable, when it doesn't. Those are very complicated things. They've made very complicated. So work with someone in that. So manage your tax liability. Again, that's the biggest wealth eroder we see as tax liability, and I don't think it's going to get better as we move forward. So income producing vehicles, we talk fixed income investments like a CD or income oriented mutual funds and ETFs, dividend paying stocks, tax exempt investments, and income annuities. So dividend paying stocks can serve double duty in your portfolio by providing income and element of potential growth. What do I mean by that? Well, you can buy stocks like AT&T, British Petroleum, Philip Morris. They're large companies, been around a long time. They pay a significant dividend, 4, 5, 6, even 7% in some cases. That income that you can have through retirement. Now, qualified corporate dividends also receive the same favorable tax treatment. They get long-term capital gains rates, so that's a good thing as well. But if a company doesn't do well, let me give examples. Looking at Ford today, and Ford had a dividend about 6% in 2018. Today it's at 1%. So they can also cut dividends. So it goes up and down just like everything else. So you can create your own pension with an annuity. Annuities are insurance-based contracts that often have a guaranteed lifetime income, which means you can't run out. You have income for life. So that's what that means. And here's a good example. When you get to retirement, you have two choices when you get to retirement. You can either trade your money for income, or you can keep investing it and take income from the investment pile. Well, one example is this immediate annuity. You can trade $100,000 and you'll get an income for life, which means when that $100,000 is gone, you'll still get income for the rest of your life. So here's an example. $100,000 goes into this income. It's going to pay out at least 20 years, longer if you live longer, and that's $7,000 annual income, or about $600 a month. And that will last for the rest of your life. Even if that $100,000 runs out after 20 years, it still goes on and on and on. So that's one way to reduce some of that longevity risk that we talked about earlier. We're going to talk a little bit about distribution methods for tapping assets. How long would a retirement portfolio last? Well, let's take two $500,000 tax-deferred accounts, and we're going to take $50,000 a year out with a 3% inflation rider each year. And so if we earned 4% on that $500,000, the first pile of money, it'll last about 11 years. If we earn 8%, it'll last about 14, 15 years. So it's very important that we know what we're getting into when we talk about distribution rates or income rates in retirement. We're going to talk about a little bit a drawdown strategy. So what does that mean? That means when you get to retirement, we have a nest egg. What's the most we can take out of our nest egg without worrying about running out? What's a good strategy for that? And there is no perfect strategy. The decisions you make will largely depend on 3 factors: the value of a portfolio at retirement, actual investment returns, right? How well the market does, and amount of timing of withdrawals. Strategies to consider: life expectancy, the 4% rule, and the 3-tier strategy. We'll talk about each one of those. So life expectancy method, you withdraw an increasing percentage of your portfolio based on your life expectancy. So for example, let's say you assume you're going to live 25 years, then you would take 1 divided by 24, and that's 4%. So if you have $1 million, you take $40,000 income. If you have a 20-year life expectancy, you withdraw 5%. 1 divided by 20, that's 5% of the portfolio. So you have $1 million in an account, that would be $50,000. So the advantage is that withdrawal percentage increases each year, but the problem is, what if your account goes down by 20 to 30%? Well, you're not going to get the same income the following year, or probably for the rest of your life as well. So there's some disadvantages to that. Disadvantage: poor market performance can reduce income in any given year. So one of the things that CPAs and actuarials developed this 4% rule, and it developed back in the 90s. And they said if you could take $1 million, you should be able to send 4% or $40,000 a year out without having to worry about running out. So we look at this: if we have $1 million in an account and we could earn 5% every year, then that account would last 36, 37 years. That makes sense. If we took 6% or $60,000 out, then it only lasts about 21, 22 years. If we took 8% or $80,000, it lasts about 15 years. Now, the only caveat about the 4% rule is they're just assuming a 5% annual rate of return. In the real world, if we have ups and downs in the market. In the real world, we can't take 4% from our assets. That's not a safe withdrawal rate. What a safe withdrawal rate actuarially today is somewhere between 3 and 3.5%. So you need to work with someone to figure out what's a safe withdrawal rate for your money. 3-tiered strategy. We should like doing this as well. So divide your portfolio into 3 different buckets or tiers. Tier 1 is a short term. So conservative assets you could draw down regardless of market conditions. So it could be money market or CD, where you take where your income's coming from for the first 2 to 3 years. Medium term, 3 to 10 years, mostly fixed type assets, possibly some stocks, some conservative stocks at that. Tier 3, longer term, more than 10 years, primarily stock market investment. The advantage: we have a manageable long-term strategy, provides a way to balance current income versus future growth. But disadvantage: take some active management. You need to be working with someone to help you figure those things out. And depends on market performance and may be challenging to coordinate. So let me give you an example of this. So we have an investment portfolio of $850,000 at retirement, and our goal is to have $45,000 a year income. So let's start at the bottom, tier 1. We take $206,000 of $850 and we put it in this conservative investment at 3%. That $206 will last 5 years if we take $45,000 out. Tier 2, we take $169,000 and put it in a fixed investment at 4%. So after 5 years, guess what? That 169 is worth 206. Now we can do that process over again. Tier 3, we take 474, we grow it at 6%, and they'll be worth 850 after 10 years, and we can begin the strategy again. So that's an example of using a 3-tiered strategy. So again, please work with someone to figure that out, what's best for your family. Also, we got to define what to spend first. You want to consider taxable assets before tax deferred. And that may not be true this year. With taxes being on sale, with taxes relatively low compared to history, you may want to sell those tax deferred assets first this year. Liquidate winners before losers. You want to work with, make sure what your capital gains are going to be, because right now capital gains are still low. So maybe advantage to sell those high appreciated assets now. Take the capital gains now while capital gains are low. Not an easy decision whatsoever. You got to figure tax consequences, opportunity costs, and emotional implications as well. So let's talk about retirement plan distribution options. So most of us will have 401ks, 403bs, 457s with our employer, if you're an employee. And we have about 4 or 5 different things we can do. One, we can keep the money in the former employer plan. Nothing wrong with that. We can take a lump sum distribution, which could cause some tax issues. We can take systematic withdrawals or lifetime annuity. Or we could just do an IRA rollover, where we open up an individual IRA in our name, and then we have more control over it. So which distribution method is appropriate for you? It all depends on your age, your liquidity needs, market volatility versus preservation, income needs, and tax situation. You really need to work with someone that knows how to walk through this process with you. We could do an IRA rollover or transfer. So one advantage of doing a rollover or transfer is we continue tax deferral. So we can move it from a 401k to an individual IRA in your name. And that way it stays in tax deferral. There's no taxes due. And when we do that, there's generally more investment options. We can consolidate funds from multiple plans. So I've worked with many, many clients that, the average stay in employers 3 to 5 years typically. So over your lifetime, you can contribute, you can have multiple 401k plans. So when you get to retirement, that gets a lot to keep track of. We can combine them all into one account, and that's much easier to administrate. We also cut some of the fees out by doing that because each account you have open has a account maintenance fee, transactions, so we can reduce some of the fees by combining some of those together, and potential legacy planning benefits as well. If you kind of combine things together, we know where things are. I've worked with enough clients where a parent passes away, they have no idea where all the assets are at. You have to kind of dig through everything to find assets that were not known about or could, hidden somewhere. So again, work with someone to figure those things out for you and your family. Required minimum distribution, very, very important. So you must start for the year you turn age 72. The first RMD can be postponed to no later than April 1st of the year following the RMD starting age. Timing could affect tax situation. Jennifer and I have clients that are in the highest tax bracket they've ever been in because they've been forced to take RMDs and they had no idea that was going to happen. And so you want to make sure you're aware of that. Failure to take a required minimum distribution could cause a pretty hefty tax penalty of 50%. So for example, let's say you were supposed to take $5,000 out of your IRA and you didn't, well then the penalty would be $2,500. So it's pretty hefty. So make sure you're aware of that, and use the life expectancy tables in the IRS publication to calculate the RMD. It's pretty simple. You take the December 31st of the previous year, based on your age, you can figure out how much comes out of that retirement account. So Roth IRA is a very, very big deal today, especially with taxes on sale. We're doing a lot of we call Roth conversions. When you do with Roth conversions, you're paying taxes today so that we get the money tax-free for the rest of your life. Qualified distributions are tax-free from a Roth IRA and do not affect taxability of Social Security or Medicare. That is a big deal because when we get to a retirement age, we don't want to have to pay tax on Social Security. We don't want to take our income to higher levels where we pay higher cost of Medicare as well. In a Roth IRA, contributions can be withdrawn at any time for any reason. So, a lot of people that we work with, Roth IRA becomes an emergency fund because we can always take the principal back out. We just can't take the growth without penalty. So it's also a good place to pull. If you have emergency, you can use a Roth IRA as emergency in some cases. Not subject to lifetime RMD during the owner's lifetime, so that's a good thing. You're not forced to take money out you don't want to. So there's some really significant advantages using Roth IRA, especially today with taxes being on sale. So you want to put your knowledge to work. You can do it yourself, but we prefer you to work with us. And as Jennifer mentioned, there's two things you can do. One, if you'd like this workbook, it's really, really handy. It's got some good notes in it. We'd love to send it out to you. You can just request it, contact that email address below. We'd send that out to you too. But if you have specific questions, you want some help with figuring out some of these rules we've been talking about, we'd be glad to sit down with you and kind of talk through your situation. We're here to help. This webinar is about educating you and then getting you help if you'd like it. Jennifer, anything you want to add to that?
No, Tracy, do we have any questions from anyone?
No, I don't have any questions in the chat right now. I've personally been thinking about a Roth IRA myself.
Yeah.
My mom, she told me that she found a lot of my mature bonds that I didn't know I had. And she's like, you know what you should do? You should just put those in a Roth IRA right now. And I was like, I don't know what a lot of those words mean, but I like the sound of it.
Yeah.
Yeah.
Yeah. So for a Roth, for someone like you can put it up to $6,000 a year in, as long as you've earned up to $6,000 that year.
Another question I noticed is, does Roth IRA have a penalty for early withdrawal before 59.5? For principal contributions, no, it does not. So if you put $10,000 in your Roth IRA over a number of years, you can always take your principal back out. You just can't take the growth. The growth, if you take the growth out, that's where the penalty comes in. So great question.
Very good.
All right. All right, well, thank you everyone for joining us tonight. We
Yeah,
appreciate
thank
you
you.
being on this webinar. We're here to help. So please get in touch with us if you have specific questions, and we'd love to sit down with you.
Thank you guys so much. This is something I'm definitely already thinking about, so you'll probably hear more from me. Thank you everyone that attended tonight. We have, just like I said before, we have Money Matters events each month, and next month we're actually partnering with Scott and Jennifer again for our How to Survive Paying for College webinar. I know my parents would have loved that.
Yeah, mine too.
A little while ago.
Yeah.
But
Going
thank you,
right
everyone. But thank you, everyone. And yeah, have a good night.
Thank you.
Thanks.